Last week, we saw mortgage rates climb back above 7%, driven by strong retail sales and inflation data. That kept the pressure on. But with more housing data, consumer sentiment reports, and key economic releases lined up for later this week, what's next for rates? Will they finally ease, or are we heading for more volatility? And what about Thursday's existing home sales report? Could it reveal cracks in the housing market, or will it show that buyers are still hanging tough despite the elevated rates? Stick around as we break down everything you need to know to make the smartest mortgage decision this week. In today's video, I'm not just unpacking the data, but you'll also learn actionable strategies to navigate this volatile market. Whether you are considering locking in your rate or waiting for a potential dip, I'll help you weigh in the risk and rewards. So, if you're ready to get the insights you need to stay one step ahead of the market, let's dive right in. This past week was packed with data releases and events that kept mortgage rates and the broader financial markets on their toes. Let's unpack what happened, focusing on the key developments that moved the needle. Monday was Veterans Day, so the bond market took a breather. Mortgage rates remained at 6.92%, unchanged from the previous Friday, as markets prepared for a busy week ahead. On Tuesday, the week kicked off with optimism in small business sector. The NFIB Small Business Optimism Index rose to 93.7, beating the forecast of 92.0 and marking a notable improvement from the prior 91.5. This showed that businesses were feeling better about the economic landscape, and that sentiment likely contributed to the sell-off in bonds that pushed mortgage rates back above 7%. Then, later in the day, markets reacted to growing uncertainty over Republican control of the House. This political outcome raised expectations for fiscal policy changes like higher Treasury issuance, which tends to pressure bond markets and drive mortgage rates higher. By the end of the day, mortgage rates had jumped 10 basis points, climbing to 7.02%, marking the sharpest increase of the week. Wednesday brought some good news for inflation watchers. The Consumer Price Index, or CPI, for October came in exactly as expected, with the headline inflation at 0.2% month over month and the core inflation holding steady at 0.3% month over month. Importantly, without the shelter component, inflation was effectively at or below Fed's 2% target. This essentially sparked a rally in the bond market, giving hope for rate stability. But as the day went on, the market's underlying inflation anxiety lingered, especially with the year-over-year core CPI still holding at 3.3%. By the end of the day, mortgage rates eased slightly to 7.01%, down just 1 basis points as the market processed these mixed signals. Thursday started with strong economic data. Initial jobless claims came in at 217,000, slightly better than the forecast of 220,000, signaling continued labor market resilience. Meanwhile, the Producer Price Index, or PPI, which measures wholesale inflation, showed a 0.2% increase month over month, in line with expectations. However, the core PPI, excluding food and energy, rose by 0.3%, lifting the year-over-year core PPI to 3.5%, a significant jump over the previous 3.3%. Later in the day, Fed Chair Powell gave a speech emphasizing a slower pace of rate cuts going forward. This cooled expectations for aggressive rate reductions in the near term, which added more pressure to the bond market. Despite the day's events, mortgage rates remained relatively steady, ticking up slightly to 7.02%, just 1 basis points higher than Wednesday. And then the week wrapped up with stronger than expected economic data headlined by retail sales for October, which rose 0.4% month over month, beating the forecast of 0.3%. Adding to the reaction, last month's retail sales were revised significantly higher from 0.4% to 0.8%, signaling robust consumer spending. Stronger retail sales signal a resilient consumer, which could keep rates elevated. For buyers, this means that affordability challenges may persist as we move into the holiday season. This pushed bond yields higher in the morning, driving mortgage rates up all the way to 7.05%, the highest level of the week. Fortunately, the bond market recovered somewhat by late afternoon, allowing lenders to reprice slightly lower than morning's peak. However, rates still ended higher than Thursday's levels. This week's economic data showed a resilient consumer and steady inflation pressures, keeping upward pressure on mortgage rates. While there were moments of relief, like the softer inflation numbers on Wednesday, the broader trend remains challenging for mortgage seekers. With markets still reacting to political and economic uncertainty, it's critical time to stay informed. With rates above 7% and last week's economic resilience keeping pressure on bonds, let's look at what's coming up this week that would change the narrative. This week's economic calendar brings a mix of housing data, labor market updates, and consumer sentiment indicators. While not every release will directly move mortgage rates, a key few reports could shape the narrative for the housing market and rate trends. On Monday, we'll see the Home Builder Confidence Index for the month of November. This report reflects how optimistic builders are about the housing market, and any weakness could signal ongoing challenges in housing supply. While it's not a major driver for rates, it does set the tone for housing-related data coming later in the week. Tuesday's housing starts and building permits. These reports will give us a look at construction activity in October. These reports could reveal whether the builders were confident enough to invest, signaling where home prices and inventory might go next. If building permits rise as expected, it might point to confidence amongst builders, despite higher borrowing costs. Strong numbers could keep pressure on mortgage rates. Thursday is the week's most important day for data. First, we'll see existing home sales for October, which will provide a direct look at buyer demand in the resale market. Sales are expected to slightly increase to 3.91 million, and stronger than expected numbers might suggest continued resilience amongst buyers despite elevated rates. If sales improve, it could mean fewer price reductions in the housing market, which is important for buyers waiting for bargains. We'll also get initial jobless claims forecast at 220,000, which will offer insight into the labor market's health. Finally, the leading economic index is expected to show another decline. A weaker reading here could hint at economic slowing, which may ease rate pressures slightly. Friday wraps up the week with the S&P Flash PMI for the month of November, which measures activity in the services and manufacturing sectors. The services PMI is expected to remain strong at 54.1, while the manufacturing is forecasted to stay in contraction territory at 48.8. These reports can influence mortgage rates by shaping expectations of economic growth. We'll also get the consumer sentiment index forecast at 73.5, which reflects how confident people are about the economy. A stronger sentiment reading could keep upward pressure on rates, while a weaker one might provide some relief. This week, watch for Thursday's existing home sales and Friday's PMI and consumer sentiment index for the clearest signal on economy's trajectory and potential rate movements. Now that we have covered what's coming up this week, let's talk about how these events could affect your mortgage strategy. This week's data and rate movements highlight just how tricky it can be to navigate the mortgage market right now. With rates staying well above 7% and economic signals still mixed, it's critical for both home buyers and refinancers to have a plan. Should you act now or hold out for potential relief? Here's how to decide based on your situation. If you're close to finalizing your loan, locking in your rate now could be a smart move. Thursday's existing home sales report and Friday's PMI consumer sentiment data have the potential to push rates higher, especially if they come in stronger than expected. Locking in now protects you from any surprises later in the week. If you're not in a rush, waiting could pay off, especially if Thursday's leading economic index or Friday's manufacturing PMI show signs of cooling economy. These could ease upward pressure on mortgage rates. That said, this approach carries risk, as stronger data might lead to higher rates instead. The best strategy depends on your timeline. If you need certainty, locking in now is the safest option. But if you have some flexibility and can handle little risk, keeping an eye on this week's data might open up opportunities. In short, locking in now provides a peace of mind, while waiting could pay off if the data softens, but only if you're willing to take that risk. This week offers a mix of data and economic signals, all of which could influence mortgage rates. Whether you are in the market to buy or refinance, it's crucial to stay informed. Rates are volatile, and key is to align your strategy with your financial goals and timeline. With rates likely to remain volatile this week, having up-to-date information is going to be crucial. That's why I post daily rate updates from the top 5 banks to give you real-time insights. This makes it easier to keep a pulse on the market and give you confidence in knowing whether the rate that you're locking into is better or at least at par with what's available out there. That's why subscribing to this channel gives you a real-time edge. You'll always know where rates stand and how to act. So, if you found this video informative, please consider liking the video, subscribing to the channel, and turning on notifications so you never miss an update on the latest rates movement and market trends. If you need help with your mortgage, want me to review your loan estimate to see if you are getting a fair deal in terms of rates, points, and fees, or just have any questions about the process, feel free to drop me a comment. I'd be happy to assist you for free. Your thoughts and questions keep these conversations going, so don't hesitate to share them below. Thank you for watching, and I'll see you in the next video.